Welcome to the Del Walmsley Radio Show. Del challenges the status quo, questions everything, and empowers you to return to your core beliefs to make your life better. If you're ready to hear the truth and get your roadmap to the lifestyle you really want, the next hour will change your life. And now, your host, self-made millionaire, national award-winning investor of the year, CEO and founder of Lifestyles Unlimited, Del Walmsley.
Welcome to Del Walmsley Radio Show, where the hype ends and the help begins. I'm your host, Del Walmsley, and as always, we're working on your financial freedom. Well, my friends, I'm going to share some ideas with you today that are kind of old school. And the reason I'm doing that is I have received some emails from people asking me some questions about how to do some things that we used to do in the past we don't see happening a lot anymore. But before I do that, I want to just take you back 30 years ago when I first started this thing and make you realize the evolution of what we do, or share with you the evolution. I don't want to make you realize, but share with you the evolution. When I first started this, there were all these real estate gurus out there: Dave Delgado, Robert Allen, Jeff McCone, Tommy Vu, the Mylans, Ron LeGrand, Carl Cheese, Robert Kiyosaki, you name it. There was a course out there. Even Donald Trump had a course. And pretty much all those courses were designed to get poor people that had no retirement future at all or no real possibility of a good job, to get them to invest some portion of their hard-earned money into a course that would teach them how to go out and buy real estate. And generally, the term was nothing down real estate. It was the concept that these poor people needed some way to trick the system. Now, the people back then that had money, they never listened to these seminars. They would just poo-poo the idea of buying real estate and taxes and tenants and toilets. They thought it was all crazy, and that any intelligent, college-educated human being that had a normal job was putting all their money in a 401k. And back then, I had to fight and fight and fight. People came to me kicking and screaming. You know, one spouse would drag the other spouse in. The other spouse goes, "No way, I'm not going to get rid of my 401k. I'm not going to get rid of my IRA. And I don't want to deal with taxes, tenants, and toilets." And it was just mind-boggling. That's all changed. Now, real estate investing is one of the most common ways for a highly educated person to increase the size and the amount of their portfolio, the profitability of their portfolio. Because over 30 years of being on the radio, 30 years of people copying what I do and creating all kinds of copycat real estate training programs, which, by the way, you have to understand, before I came along, there was no real estate training program. There were courses you could take from CDs is the most current ones. Backwards, it was audio tapes, and back before that, it was even eight-track tapes. I mean, that's all you did. You bought some tape, books and tapes, you took it home, and you digested it and tried to go out and do it on your own. I was the first one to put together a course where you literally had an office to come to, people to go through the deals with. And once people caught on to how successful that was as a training method, my students started popping up programs all over the country. And then even people that weren't my students who just copycatted me started popping up all over the country. And hence we are where we are today, where real estate investing is one of the most popular ways to create wealth. So today we're going to talk about some old school stuff, and then we're going to talk about the current market conditions and what you can look forward to in this kind of a market. And to do that and to help with that is my sales manager from Lifestyles Realty, which is one of my sister companies I own, which is a real estate sales company, is Jeff Smith, who is the sales manager for Lifestyles Realty. Jeff, welcome to the show.
Hey, Del. How are you?
Very good, sir. Thank you. I got a couple questions for you. I'm going to want you to walk us through them. You were around back in the old days when we were all in quest for the something for nothing, all in quest for the low down payment deals. I mean, I remember buying house after house after house for no more than $2,000 out of pocket. It was very common when I started. I mean, I'm probably the first 10 or 20 houses I put almost nothing down on. You lived through that era also, and so you remember it. Nowadays, the era has completely changed, and you're going to share with us, if you will, today, the difference. But let's start first with, in the old days, Jeff, they used to have tricks, and I hate to call them tricks. I definitely don't call them secrets because they're never secrets, but they were tricks that people would use to get into real estate. And one of the tricks was to buy anything from a duplex, triplex, or a fourplex, which is still considered single-family housing and still got single-family financing privileges, in other words, the ability to get into the deals for much less than commercial. They would take and buy one of these kinds of deals and live in one of the units, hence calling it a personal home. rent out the other units, whether it's duplex, triplex, or fourplex. The other units that they're not living in, they'd rent out, but they would be able to use this preferred financing package to get in. And I mean, the rate of return on a deal like that, Jeff, if you can go through some numbers, it's astronomical. If you can buy one for 3% down to live in and you have 3 other units that are paying you rent, four rental payments tied to a small down payment has got to be an astronomical rate of return. What do you say about this?
I think it's a decent way to get started. Especially if you're young, you don't have a family yet, and you don't mind living near your tenants. I mean, if you're screening your tenants well, it can be very, very lucrative way to get started. In the example you're using with a fourplex, well, actually any personal residence you can get as an owner occupant, you can get 3.5% down payment through an FHA program. And so if you're only putting 3.5% down on a property and you're getting 3 other units to pay the rent, and then a year later when you move out and do it again, you'll have 4 units paying rent on. Really, if you're looking at this today, let's say you're looking at a $250,000 property, your down payment on that is under $10,000. It's $7,500 in this example, and the median rent in Houston right now for a single-family home, I don't know what it would be for a duplex unit or a townhouse unit, but for a single-family home, the median rent in the Houston area is $1,750. So if you just figure something less, maybe $1,200, $1,300 a month for a townhouse style unit, you're 3 of those on a $7,500 investment, and I'm not forgetting closing costs, because in that kind of a loan, you can negotiate for the seller to pay your closing costs as a buyer up to 6% of the sales price. So you're looking at a $7,500 investment, and for the first year, revenues of, let's call it $1,200 a unit for 3 units, that's $3,600 a month. Like even if you didn't finance that's a good return, but with leverage, it's just outstanding.
Wow, so you're talking about here $1,200 a month. It doesn't take into account the expenses, or does it?
No, it doesn't. That's your revenue.
So what would you say the positive cash flow would be on that? Let's get down to that number.
I'd say $400 a month.
400 each unit? So 400 times 4 is $1,600 a month, times 12 is $16,032. That's $19,000 a year, give or take some bad math on the radio. So $19,000 a year on a $7,500 investment. That's over a 200% return, Jeff.
Just on cash flow. So that's true. Now that's year 2 and beyond. Year 1, remember, you're living in one of those units to get the 3% down loan product.
Okay, so that's $1,200, and 12 times 12 is 44. 144. It's $14,000 a year. $14,400 a year to $7,500 is still 200%, isn't it? Nah, it's just a slight under, like 190% or something. That's unbelievable.
Yeah.
I'm surprised more people don't do this. Now, my counter to it when I used to teach in the beginning was that, man, I wouldn't want to take my family and live right next to my tenants. But you're right. Take a single person or even a young couple that don't have any kids yet. That really wouldn't be much of a break. We're going to be right back with Jeff Smith and the Del Walmsley Radio Show.
Welcome back. Now here's some more unconventional wisdom to set you free from the man on a mission to retire America, one person at a time, Del Walmsley.
Welcome back to the Del Walmsley Radio Show. With me here today is Jeff Smith, which is the sales manager for one of my companies called Lifestyles Realty in the Houston market. And Jeff has been around Lifestyles now for 20 plus years. I don't know exactly how long, but it's almost as long as I have. And he's seen it all happen. ups, the downs, the sideways, the whole bit. And being the sales manager, he tracks all that stuff for us, so he's right on top of what's going on. Here is a question I didn't warn you I was going to ask you, but I think it's soft enough that you can figure it out on the go, and that is, back when I was doing this, I owned, there was 3 fourplexes up on Jones Road, 1960, and Perry or something like that. There were, that I owned fourplexes down in Behringer Knoll and in Behringer Way, where there were at least 20 or 30 fourplexes, 20 or 30 fourplexes in each of those areas. I owned 5 duplexes on Tower Oaks Boulevard. The point I'm getting to, there were hundreds of places, there was hundreds of properties that were generally situated in groups of, say, 5 or 10 either duplexes or fourplexes or whole subdivisions of them. Are those things still around, and are people still buying those?
They are still around, and yes, people are still buying them. These things are. I will say though that when someone buys let's say there's 4 fourplexes that are all adjacent to each other, a lot of times we'll have somebody buy all 4 of them and then treat it as a commercial property. They'll just buy all 4 of them at once. So it's a different strategy than we were talking about in the last segment, where you would try to get owner-occupant financing. In this case, you'd have to get a multifamily loan. In fact, I've a listing right now that is 8 units that's just like that should go under. I'm expecting it to go under contract today. We have accepted an LOI, and the buyer's going to do exactly that. It's 2 fourplexes adjacent to each other, and my client bought the property 5 years ago. He's more than doubled his money on the deal. The next guy should be able to do the same thing, and in this case, it's just a matter of improving the operation of the property, but many of the same principles apply, and the availability is still there. Now, inventory across the market as a whole is really tight, and so it's a lot tighter this year than it was last year, but this segment of the market is no different. It's tighter, but we're still doing business.
Now, I'm going to ask you a very complicated question. We're going to lose some listeners on this one, Jeff, but I would just like to hear your opinion for my own edification here, and that's, back when I was doing this game, the way I would do it is I would buy them as a commercial deal. Like, I bought 5 duplexes as a commercial deal, and I paid $20,000 a door for it, and it appraised off its NOI as a commercial deal. But then I turned around and broke those up into 10 single-family units. And the single-family units in the neighborhood were appraising for $40,000 a door. So I went from a $20,000 a door appraisal in a commercial deal loan to a $40,000 a door. Actually, it's $45,000 a door, so it's $450,000 on a residential loan. Okay, so I was able to go from commercial to residential and double my money. Now, I also saw people that went over to Derry Ashford and Westheimer, and there's a whole group of duplexes and fourplexes there. A Meadow on the Mews, I think, is what it was called. And some ignorant investor didn't know what he's doing, bought that place as residential properties, turned around and turned it into an apartment complex of about 100 units, and the value went from $40,000 a unit down to $10,000 a unit because the NOI was so low. Just dumb as a rock, right? Just dumb as a rock. So what I'm wondering with you is, when you're seeing this right now, can you get more appraisal out of a property like that as a commercial deal, coming off the NOI approach to value, or residential appraised values? Because residential values are very high right now also.
In the case of a duplex, I think you're right. My aunt, my Aunt Beth, she's considering that with one of her duplexes at the moment, because this is one where she's probably owned it for 25 or 30 years, and the appraisal that we're expecting on each side of this duplex, it's just the rate of appreciation that we've seen over the last 10 years in the last year has been crazy high. But we're seeing prices that she can get out of these duplexes at 10 times what she paid for the property 25 years ago. So she's really considering taking that and reinvesting it.
Is that on a residential loan or on a commercial deal?
Well, it's a duplex, so it's a residential loan.
Okay. So you understand what I'm saying, though. I'm asking you, if you bought, say, 5 of them together, and you bought them commercially from some dude that sold them all to you, and you wrapped them into an LLC and called them, commercial property. Then would you be better off selling it as commercial property or breaking it back down and getting residential appraisals per building?
I'm guessing that the demand is so high right now, and on the commercial side, with where we're seeing cap rates, the difference would be negligible. I'm guessing on threeplexes and fourplexes for sure. That most of what I'm seeing is that folks who are however they bought it is how they're selling it. Making the conversion would just delay the sale if they're ready to sell.
I got you. So it's not that much of a difference anymore, then, huh?
Not for triplexes or fourplexes. Now, if you were to, with duplexes, if you were to break them up individually, like I used to have an office over on the other side of Jones from the 5 duplexes you're talking about. I used to drive past them every day. And in a scenario like that, where you had 5 duplexes and you sold each of the 10 units by itself, clearly you'd come out ahead making the conversion to single family. But most of the way that the fourplexes that we're working with are built, they're more like, if you were to do that, it would be more like a condo. It would be I think a tougher route.
All right. Well, we're going to take a break now. When we come back, Jeff, what I want to go into is the marketplace today. I've had many emails come into me, and I told a gentleman we'd touch on this today, so he's listening special just to hear this. We'll be right back with Jeff Smith and the Del Walmsley Radio Show.
Welcome back. Now here's some more unconventional wisdom to set you free from the man on a mission to retire America, one person at a time, Del Walmsley.
Welcome back to Del Walmsley Radio Show. With me here today is Jeff Smith, the sales manager for Lifestyles Realty out of Houston, Texas. He's helping us out with some market condition questions. Jeff, a couple years back, I did a show called The Black Swan, where I explained to people that the traditional up and down movement of a market, which was, almost like a sine wave, and had been normal for markets for centuries, was gone. And that there was now something I called a black swan event, which said that the government is no longer going to let the value of things go down, and that market where we keep thinking it's too high, it's too high, it's too high, it's too high, it's going to blow, just isn't the case. Guy wrote me a email, said, I just listened to your podcast on the black swan event. It's amazing how accurate some of your predictions were just years ago. I'm curious your thoughts today on these same topics. Do you still think housing is continuing to appreciate at this time? It seems that the government and the Federal Reserve will do anything to keep asset prices up in everything, real estate, stocks, bonds, etc. Look at what's happened last March. It's soon as it got bad, they stepped in and propped it back up again. Jeff, how do you see this? I'm tending to believe the black swan effect is still in effect. I don't see anything going down on either side of me anywhere. What about you?
Well, no, I don't. I mean, and I can give you several reasons why. Now, the one thing I keep hearing about is all right. As soon as the government relaxes some of these eviction and foreclosure rules, that there's this great big number of foreclosures in the pipeline, and it just doesn't seem like that's the case to me. Just in the last year, February to February, the median price of a Houston area single family home, the median price, not the average, which is going to be $75,000 higher than this, but the median price is $276,000. That's over a 12% increase. And the reason we're seeing these increases, when a lot of people, when the lockdown started a year ago, expected things to go in the opposite direction, is that the demand for these properties hasn't changed. And in fact, sales are up, but what is available is down considerably. We are looking at the number of active listings in the market today is 38% below what it was last year. months of inventory for single-family homes is at 1.6 months. A market that is normal is considered to be 6.5 months. So we've got a long way to go before you get to any kind of place where you would be thinking that the market is switched.
Let me clarify that for a second, Jeff, because you're rattling through it, and some people out there, beginners, don't understand what they understand what you're saying, but they can't put two and two together. What you're saying is there's so much demand for this stuff that if all of a sudden they allowed foreclosures, the stuff would be sucked up instantly. You'd hear a big sucking sound, and those foreclosures would all be gone. Is that what you're saying?
Yes, that is what I'm saying, if those foreclosures made it to market. But there are a number of these large funds that have been recapitalizing over the last year that I don't know that even a majority of any foreclosures that may be coming would make it to a full market. I think they might be sold in groups to these funds that are buying properties to rent them out. In fact, builders are now building to rent, building entire subdivisions that they don't intend to sell the property, that they're building them to rent them.
Wow, that is unbelievable. To have that type of a rent product ratio, that's just, I've never heard of that before.
I think you may have undersold your Black Swan event theory.
Well, so it's still good, though. We're still making money. You went through with me the other day some numbers on what kind of rents and rate of returns we're getting. It doesn't appear that the rate of return has gone down, even though the house prices are up 30-40% from before. The housing, the rents are up, and you said also the interest rates are so low. Give us an idea what kinds of rates of return you're seeing coming out of these deals, even though they're more expensive.
Sure. We're looking at almost 20% cash-on-cash returns as a median. Now, you know the difference between a median and an average, and the reason I go with median is because we do enough of these nothing down, or very low down payment deals that if I gave you like an average cash-on-cash return, like of the transactions we closed at Lost Sales Realty last year, if the average cash-on-cash return was 6,000%. That's not a number that we can, work with. But if we go with the median, where half of them were below this and half of them are above this, we're looking at a 20% return just from cash-on-cash and a 70% return on gain, right, or a gain return on cash. So you're getting a 70% equity increase right out of the gates. You're getting a 20% cash-on-cash return, and really the difference in how the properties look, what we're doing this year compared to last year, and I'm using last year because my numbers go through February. The lockdown started in March, so I'm looking at what this year versus last year is a pre and post incident type of scenario. And what we're looking at, we paid the sales price of $103,000 last year for a single family property. We're still paying that this year. The difference is the value. The appraisals that we're getting has gone from 165 to 182. So we're increasing that spread between the price and the appraisal, but also the rehab materials costs are increasing. Some of the rehabs are a little bit more. The rehabs have gone from high 20s to mid 30s. So when you put it all together, the rates of return are the same. We're getting closer to $500 a month cash flow. Last year we were getting closer to $400, but the cash out of pocket to get that $500 is a little bit more. We went from the low 20s to the mid 20s.
So, Jeff, let me back into this for a second. You tell me if I'm just totally off the wall, but is it a possibility that the real estate investment market as a whole, driven largely by 50,000 Lifestyles members around the country and then all of the people that are auxiliary to that who buy these single-family homes for rentals, and I'm sure our 50,000 people are a large percentage of this, not counting going against, BlackRock and all these big buyers, right? But just as individuals, we're probably a very high percentage of that. Do you think that we've locked into our minds that we need a 20% return? So if building materials go up in price, we've got to have a better spread so that we're demanding that we're waiting for the deals to get to that point where we can get that spread so that when you have the higher demand, for appraisal, where you can get the lower interest rates, and you put that together and you then factor in, okay, I can pull this off even though the cost of rehab is higher. It still fits my bundle that I'm looking for. Is that what's really happening? Is it really the market being controlled by the demand of the buyers?
I hadn't considered that. To use an analogy, I always figured that we were the more skilled surfers on the wave, but I hadn't considered that we might be the wave. And so I don't know. I hadn't considered that we were the driver of it. I always figured that we were just more skillful, but it certainly is possible that we are the cause.
Because I talk to people all the time, Jeff, and I know you've been with me for a very long time. You've met a lot of brand new members who talk about the first 1 to 5 houses they buy before they join Lifestyles, and how they're almost every time they buy no equity into the house. They don't estimate the rehab well enough, and they ended up either breaking even and losing money on most of those deals when they don't know what they're doing. So if that were the case, don't you think these deals would be flatter?
Yeah, I see your point. There were enough of those stories where people say, I wish I would have met you guys before I tried to do this myself. I got to believe that what you're saying is at least partially true, if not totally.
All right, we're going to take a short break, and we'll bring Jeff back for the final segment. We'll be right back with Jeff Smith and the Del Walmsley Radio Show.
Welcome back. Now here's some more unconventional wisdom to set you free from the man on a mission to retire America, one person at a time, Del Walmsley.
Welcome back to Del Walmsley Radio Show. With me here today is Jeff Smith, the sales manager for Lifestyles Realty in Houston, Texas. Jeff, as we went to break here, we had talked about the fact that you've come across many, many people that had done it wrong before they got here. I'm going to share with you an email about another type of person we run into, and that is the type of person that no matter what they hear about us or about what we do, they just will not conform. And then I'm going to get your opinion on this, and if you've run into these people, what do you do? I'm going to read this. I have a friend who for the longest swears rental real estate is too slow for him or it's too risky, so his investment strategy is to fix and flip. He hates the thought of buying and holding because it's too slow, but somehow fixing and flipping is less risky than holding rentals. Ha ha ha. But today he just called me a little stressed, talking about how he feels like he has some bad juju going on or something, because every time he is trading on Forex or day trading, he's losing money. Just this week, I believe he said he lost about $15,000. Now, I know for a fact that's a good amount of money that could have gotten him a house somewhere that would have cash flowed monthly, and he would have some equity captured, but instead he's beating himself up over those stocks. So after he vents for 30 minutes and about everything he's lost, he says he's not going to continue looking for real estate deals because he feels like he just has too much bad luck. So I say, okay, what are you going to do? Just not invest, he says, for a while. I can't make this up, he says. I'm going to keep trading, of course. I've got to get my money back. And then he goes, ha, 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 as if I just shook my head. He's going to go back to the thing that lost him money and expects to utilize it to make money. I went on for 45 minutes ranting about your 3 rules of never losing money, got to have cash flow, and you can't get rich slow. Then I broke down the returns people presented in case study on March 4th in single family and even multifamily, which he has enough money to do passively. And after all the facts I presented him, he agreed the returns were great, but it's just not for me. I just said, wow. And we finished our conversation about something else and hung up. I just couldn't help but wonder what Del Walmsley would say about this. Jeff, let's tear this apart. Let's start with one simple question. What's going on with the buyers, the fixer and flipper guys right now? I heard from Lynn, I thought that they're starting to narrow. There's not as many of them. They're getting pushed out of the market. What do you see?
Well, they are. Just overall, inventory is a lot lower than it was. And the guys who are consistently successful at doing the flipping aren't doing the buy, fix, and sell. They are getting control of properties and then selling them to us. Right, and so they're taking a little piece, and then we take the long-term piece. And they then have to keep doing this over and over again. Those guys are spending ridiculous amounts of money every month just on marketing. The guys who are higher volume type flipping, and a big part of their business is wholesaling the properties to us. So we get a great deal, they get a good deal, and the relationship seems to be symbiotic. So because of the barriers of entry, namely the budget they have to have for marketing, and then the tools they have to deal with all the title problems that they encounter, they clean that up before the deal gets to us, and it really keeps the smaller time guys from really getting any traction. So. And plus, the wealthier people that I've met in real estate are doing what we do. The people who really do well hold the real estate. They don't get rid of it. Matter of fact, I think I've regretted every sale, every time I've sold one of my properties, and looked back at how that thing would have performed had I kept it. And
I have that same feeling also, Jeff, except I have to then remind myself that the money I took out of that deal, I 10X'd it back up to, larger deals. Right. That's where you make the difference on that. So you're right. I hate everything I've ever had. I look at it now and go, man, gosh, I went up in value. So, but you can't have it all in both ways. So we're looking at this thing and this guy's saying it's slow. You ever remember when you were a kid, the story of the tortoise and the hare?
I do, yes.
That's what this story reminds me of. The hare is all over the place, running fast, going fast, doing things, activity. At the end of the thing, the tortoise, the slow, and the steady win the race. I think slow and steady at 1 or 2% returns doesn't get you there, but I think if you're slow and steady at 20 to 30% returns, which you're talking about, and, we're not even talking about the capital gains thrown in on there, which makes it go up even higher. 60, 70% seems to be the number I'm seeing averaged out there on deals lately. I think the slow and steady is going to get it.
You got it. And the people who are afraid, you're going to encounter them all the time. You just have to do it anyway. My family, and I've been doing this for 20 years, and my wife's parents were doing this for 20 years before that. And other people in my family, having seen what this kind of investing can do, still are doubtful. So, I'm sure in your family you have doubters in spite of all that you've accomplished.
I have nobody. I think one member of my entire family, one in all directions, has ever joined Lifestyles, and that's a guy that I met just a year ago that is my same age, and I met him just a year ago. I'd never met him before, and because he didn't know me, he didn't have the fear of doubt. So it was a good thing. Well, Jeff, I appreciate you coming on today. I'm glad you keep track of all those numbers for us like that, and you're doing a great job. Keep helping people change their lives out there. And for the rest of you out there, keep this in mind. We're talking about money today. We're talking about deals today. What we're really talking about, though, for 30 years is the quality of your lifestyle. What are you doing? Are you ever going to be able to retire or at least know you have enough money to survive? That's it. Not the money. It's the lifestyle.
The information and opinions you hear on the Del Walmsley radio show are those of the host, Del Walmsley, his guests, and his callers, and do not necessarily reflect the opinions of this station, its affiliates, its management, or advertisers. The Del Walmsley show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Del Walmsley show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.